To get his take on what's going on at the Fed, Jim Rickards is on the show. Jim is the editor of Strategic Intelligence and also the author of the new book, The New Case for Gold. Just yesterday, the Fed announced that they would keep interest rates unchanged, which really came as no surprise. The question, however, is whether the Fed will stick to its plan of issuing 4 interest rate hikes throughout 2016. I first asked for Jim's thoughts on that, and here's what he had to say.
Well, yes, I don't think they'll get there, to be clear.
Okay.
I think they'll do one high degree of probability, probably 2, and then they'll stop. The reason they'll stop is because they'll see by the summer what everyone else sees today, which is we're in a recession. Now, why doesn't the Fed see it? Well, the reason is they're model-based. I mean, their models tell them we're not in a recession, but they don't look at the real world, they look at the models, and that's the problem. That's why they're the last to know.
You think we are in a recession? Not that we're necessarily headed, but that we are already
Close
there?
to it. Well, look, we've been in a growth depression since 2009. I mean, we've had, about 2% growth. It's actually looks like it fell lower in 2015. The fourth quarter looks like it's well below 1%. The full year is going to be well below 2%. That's down from the year before. So, our potential is 3.5%. So that gap between, let's just call it the gap between 2% and 3.5%, that's a growth depression right there. That's just kind of the state of the world. But beyond that, whether we're in a technical recession remains to be seen, but we're close enough.
It's been about a month since December's interest rate hike, of course, the first time in nearly a decade that the Fed moved to do so. How would you assess the economic impact of that? Has it been significant?
Sure. I mean, just look at the stock market, look at emerging markets, capital outflows, look at what's going on in China. There's a dollar shortage around the world. And by the way, that rate hike, everyone said, 25 basis points, who cares? It's such a tiny amount. That's not how markets think. Markets discount the future. So as long as there was uncertainty about whether you're going to raise or not, that's one state of the world. But once you actually raise, you remove the uncertainty, and then you get people thinking, what are the future expectations about rate hikes? So you have to bring the whole yield curve forward. So, and by the way, the Fed has been tightening since May 2013. I understand that was the first hike in December 2015, but they did the taper talk in May 2013. Right. They did the actual taper in 2014. They removed forward guidance in March 2015. These are all tightening moves. So they've been tightening for 2.5 years. Monetary policy works with a lag, and so we're seeing the effects.
Right. So given the effects that we are seeing, right. I mean, do you think that has changed their course of action going forward at all?
No, because as I mentioned, they don't actually live in the real world. These are very high IQ people. They spent their whole lives practically either in universities or think tanks or at the Federal Reserve itself. Johnny Yellen is a perfect example. They're very disconnected from everyday Americans and actual markets. So they rely on models. Their models are obsolete, but you have to study them anyway to understand the mistakes that they're making. So you look at, my models are quite different, but the Fed's not using my models, so I use them myself. But if you want to understand the Fed, you have to understand their models. They're deeply flawed. They're equilibrium models. The world is not an equilibrium system. It's a complex dynamic system. So they've got the scenario wrong, so you should expect bad policy.
All right, well, let's move on and talk about your new book, The New Case for Gold.
Thank you.
Now, without giving away the entire book,
right.
Tell us, what is the new case for gold? Sell us on it.
Sure. Look, the arguments about gold have been going on forever, 5,000 years, let's say. But even since 1971, when President Nixon stopped the redemption of overseas dollars for gold, there's been no gold standard in the world. So people have been debating, should we go back to it? A lot of the debate is kind of tired. It's relevant, it's important, but the point I'm making in the book is there are new 21st century arguments in favor of gold, including cyber financial warfare, the war on cash, power grid vulnerabilities. What if all the ATMs were shut down? What if some foreign power, Iran or somebody else, hacked into your bank account, wiped out your savings? I run into people, they say, gee, I'm a billionaire. I say, really? Tell me about it. And they say, oh, I've got stocks and bonds and all this. I say, no. What you have are electrons. You have digital wealth. Very little of your wealth, perhaps, is in physical, tangible form. All that can be wiped out by Chinese cyber brigades, Iranian cyber brigades, and others. So it's extremely vulnerable. So that's a reason to have gold, because it's physical, it's non-digital, it can't be hacked, it can't be erased. That argument was not on the table 30 years ago. It is on the table today.
What's interesting, though, is that the Fed is beginning its tightening cycle, or as you said, began it a long time ago as it began to talk about it. So, with higher interest rates sort of in the future, in the near future, a stronger U.S. dollar, the question is if that's going to lead to weakening gold prices. With gold priced in dollars, is it really the best time to be investing in gold?
Well, there's a little bit of a tug of war going on. So you're right, Amir. So the Fed says they want inflation. They have an inflation target of 2%. They haven't come anywhere close to it in 3 years. It's actually moving away from them. They're tightening monetary policy, raising interest rates. That makes the dollar stronger, which is deflationary. So if you have an inflationary goal and you're pursuing a deflationary policy, how does that work? It doesn't work. It makes no sense. This is part of the absurdity of what the Fed's doing. But gold does. Everyone knows gold does well in inflation. That's easy. So the Fed will get their inflation sooner or later. It's taken a long time. And by the way, in extreme deflation, gold does extremely well. In 1933, the U.S. had just gone through the longest sustained period of deflation in American history, and gold went up 75%. The reason is the government made it go up because they were so desperate to get out of the deflationary trap that they raised the price of gold in order to inflate the price of everything else. So gold does well in inflation. It does well in extreme deflation because people will get desperate and raise the price of gold. Right now, I'm actually surprised gold hasn't gone lower. I mean, when you look at the price, oil's down 70%, iron ore is down 70, 80%, copper, all these things are down 70, 80%. Gold's down, okay, 50% from the high, but it's.
But it's doing pretty well given
relative
the global
to other
factors.
Things. Why isn't it 850 or 900? It's held up pretty well, and now it does seem to have a pretty strong foundation.
Yeah, that's a good point. So if someone like me reads your book, I'm not an investor in gold right now. Where would I start? Where would I want to invest right now? I mean, would I be interested only in physical gold, as you were just talking about, or would I be interested in stocks or ETFs, or what route would someone like me go?
I recommend physical gold, Mayor, partly for the reason I mentioned, which is that it's you can't hack it, you can't wipe it out, so it's solid that way. Keep it in non-bank storage. The banks will be vulnerable if the government decides to seize the gold. They'll start with the banks because they can regulate the banks. So you want non-bank storage, but make sure it's a reputable vault. There are very well-established reputable vaults out there. I don't recommend gold futures, for example, because one of the problems with gold futures is that when everyone demands their gold, there's an enormous short squeeze. The exchange won't give you physical delivery. They'll shut down the contract. They'll pay you yesterday's closing price. I'm not saying they'll steal your money, but you'll get paper dollars at yesterday's price, and you'll miss out on the big move today. All the futures exchanges have rule books that say they can do that. They can order traders to do what's called trade for liquidation only, which means you can't actually take physical delivery. Same thing with ETFs. So all these things have loopholes, force majeure clauses, exceptions. When you actually want your gold, you're not going to be able to get it.
So I guess that means I can justify buying gold jewelry, gold necklaces,
Absolutely.
gold
Well, we're in
rings.
Indian women love it. I criticize the Indian government because they only have 500 tons of gold approximately, but my Indian friends say, no, but the country has 15,000 tons of gold because of all the brides.
Exactly.
It's wealth, and
it's popular there. It's popular in the Middle East
correct.
as well.
I call jewelry, it's wearable wealth. It's attractive, but it's still
and
wealth.
that's what's so great about it.